162. I mean, just let that number sink in for a second. The Japanese yen has just broken above 162 against the US dollar.
Which is honestly wild to see on a chart.
Right. To find the yen this week, you have to rewind all the way back to December 1986, like the Reagan era.
Yeah, it's been about 40 years.
And this isn't just some anomaly on a foreign exchange chart. It is a massive structural shift in global finance. Welcome to today's deep dive, where we are going to unpack exactly what this means for you.
Because it fundamentally rewires how global capital flows. The foreign exchange markets are basically screaming that a massive dislocation is happening right now.
Yeah, but if you glance over at U.S. corporate credit markets, everything looks incredibly placid. And that disconnect, that gap between those two realities, is where the real systemic risk lies.
It really is. It's a ticking time bomb for global credit markets.
Exactly. And unpacking that specific disconnect is our mission for you today. We are pulling from a massive stack of sources to figure out why this currency move is actually, well, it's a credit story.
We've got live bar chart market data, historical Federal Reserve texts, private credit origination reports.
Right, and some deeply fascinating network relay models to understand the mechanics here. The goal is to see why this yen breakout isn't just FX noise. Before we jump in, just a quick reminder that this deep dive is an exploration of macro financial mechanics, not personal financial advice.
Always good to clarify that.
Definitely. So looking at the FRAID data, the St. Louis Fed's database that tracks like 21,000 indicators, the setup is stark. The U.S. Fed has held interest rates high, while the Bank of Japan has been historically slow to tighten.
And that gaping interest rate differential is the entire engine of what we call the carry trade.
Right, the carry trade.
Yeah.
Yeah.
When we talk about a carry trade, we are essentially looking at the basic mechanics of yield farming, but on a sovereign scale.
Yield farming for countries, basically.
Exactly. An institutional investor borrows yen in Japan, where the cost of capital is hovering, near zero. Then they immediately convert those yen into U.S. dollars.
And then they deploy those dollars into high-yielding U.S. assets.
Right. They are harvesting the spread or the carry between Japanese borrowing costs and American yields. And as long as the yen continues to weaken, or honestly, even if it just stays flat, they are essentially printing free margin.
Okay, let's unpack this. Because if I'm an institutional asset manager moving billions of dollars in this trade, I'm certainly not leaving this cash in a traditional checking account on Wall Street.
Definitely not.
I mean, I'd be subject to domestic reserve requirements. I'm looking for regulatory arbitrage to maximize that margin.
Yeah.
So are our sources pointing to the Eurodollar system here?
They absolutely are. It bypasses the domestic banking infrastructure almost entirely.
Because reading through Jeff Snyder's research at Eurodollar University and the Richmond Fed texts, it seems like the bulk of this capital never actually touches the U.S.
What's fascinating here is that to understand the Eurodollar system, you have to look past the name. It actually has nothing to do with the European currency.
Right. It's misleading.
Totally. A Eurodollar is strictly a U.S. dollar-denominated deposit held in a bank outside the regulatory jurisdiction of the United States.
Okay, wait, let me test an analogy here to see if I have the mechanics right. Let's think of it like global shipping lanes.
I'm sure I like that.
If the U.S. domestic banking system is a tolled canal, complete with speed limits, Coast Guard inspections, expensive tolls, then the Eurodollar market is the open ocean.
That is a highly accurate way to visualize it.
Banks route their massive dollar liabilities through the open ocean because they don't have to pay the FDIC toll or, pack expensive lifeboats in the form of non-interest-bearing reserves. They can sail faster, cheaper, and carry more cargo.
Yeah, that regulatory arbitrage is exactly what's at play. And our sources on the relay power model explicitly map this out, because people often confuse offshore banking with the secrecy of tax havens.
Oh, like the Apple double Irish maneuvers?
Yeah.
Or the hidden yachts of the 1% we saw in the Paradise in Panama papers.
Right, but what's fascinating here is that tax havens use nominee directors and bearer shares to hide beneficial ownership. The Eurodollar market isn't about hiding who owns the money.
It's just about minimizing the friction of moving it.
Exactly. It's about bank funding margins. Because these offshore banks don't hold reserves or pay insurance premiums, they operate on razor-thin margins.
Which means they can offer slightly better yield to depositors and slightly cheaper leverage to borrowers.
You got it. And that hyper-efficiency is what makes it the perfect conduit for the yen carry trade.
So we have this massive unregulated ocean of offshore dollars, and there is a critical mechanistic shift in how that ocean operates that the sources highlight, right?
Yeah.
The transition from LIBOR to the SFR benchmark rate.
Yeah, that transition is huge. LIBOR was the London Interbank Offered Rate, which was essentially an unsecured trust-based rate.
A lot of trust involved there.
Too much, as we found out. But as of the mid-2020s, the benchmark is SOFR, the Secured Overnight Financing Rate.
So why does that shift matter so much for the carry trade?
Well, it changes the entire collateral profile of the offshore system. Because SOFR is secured by U.S. Treasuries, it inherently links this massive offshore shadow banking liquidity directly to the U.S. sovereign debt market.
Oh, wow. So the collateral demands are now structurally tethered to treasuries.
Exactly. This gives these offshore entities a profound amount of leverage, provided the collateral holds its value.
Okay, so if this Eurodollar engine is hyper-efficient at converting cheap yen into highly leveraged dollars, that money has to go somewhere. It needs yield.
It's a wall of capital hunting for a home.
Right, and that massive wall of capital crashing into U.S. corporate bonds explains the current state of credit spreads. Let's look at the actual numbers.
The compression is honestly staggering.
It really is. When we look at the spread, the extra yield an investor demands to hold a corporate bond over a risk-free U.S. Treasury investment grade spreads are sitting around 76 to 95 basis points.
Which is incredibly tight.
And high yield, or junk bonds, are compressed down to 278 to 283 basis points.
To put that in perspective for you listening, investors are accepting less than a 3% premium to take on junk-rated corporate default risk. The market is pricing in absolute perfection.
It's basically saying there's zero default risk.
Yeah, which is entirely a function of this wall of liquidity blindly hunting for yield. It's not a sober assessment of corporate balance sheets at all.
And the institutions directing that fire hose of liquidity are what the architecture of power sources call the financial core. We are talking about the ultimate arbiters of capital here. BlackRock, Vanguard, Fidelity.
Biggest players in the game.
Interestingly, the research notes that Schwab operates a bit differently here. They notably lack an automatic sweep into high-yielding money markets for uninvested cash.
Right, which traps some client cash in lower-yielding accounts. It sets them slightly apart in how aggressively every single dollar is deployed.
But broadly speaking, the financial core is functioning as a relentless buyer of U.S. credit, fueled by offshore carry trade capital.
And we also have to look beyond public bond markets to fully grasp where this capital is accumulating. The Apollo Global Management reports in our stack reveal a massive acceleration in private credit.
Oh yeah, those numbers were huge.
Apollo and its platforms originated $309 billion in assets in 2025 alone. They are aggressively expanding into private investment-grade credit and hybrid yield.
So they aren't just buying existing bonds, they are acting as a shadow banking system, directly financing corporations backed by hard assets.
Exactly, bypassing the traditional syndicated loan market entirely.
So the causal chain is incredibly clear. The Bank of Japan keeps rates low, weakening the yen to 162. Institutional players borrow those yen, convert them to dollars via the offshore Eurodollar shipping lanes, and hand them to the financial core and private credit giants like Apollo.
And those entities indiscriminately buy U.S. credit, crushing bond spreads down to historic lows.
It paints this beautiful, profitable mirage of stability. But it is entirely dependent on the yen staying weak. What happens if this breaks? Like, what if the Japanese Ministry of Finance intervenes?
Or if the Bank of Japan aggressively hikes rates? The math of the carry trade completely inverts. Suddenly, the loans these institutions took out in yen become much more expensive to service.
So they face immediate margin calls.
Huge margin calls. And to meet them, they are forced into mass liquidation. They have to sell their U.S. assets, those corporate bonds and private credit instruments, to buy back yen and close the trade.
So it's not just that the yen gets stronger, it's that a stronger yen triggers a fire sale in U.S. corporate debt.
Precisely. And when everyone rushes the exit door simultaneously, those tight credit spreads of 280 basis points on high yield don't just gently widen.
They gap out.
They gap out hard. We could see spreads spike by hundreds of basis points in a matter of days, completely freezing corporate lending.
And we actually saw a preview of this volatility, right? The August 2024 carry unwind.
Yeah, that was a perfect mini example. Jeff Snyder's analysis frequently warns about the fragility of the global collateral system in these moments.
When forced liquidations begin, collateral markets freeze up entirely.
Repo rates scream, and swap spreads immediately predict major banking stress. The interconnectedness of the collateral means a shock in Tokyo instantly drains liquidity in New York.
And the speed of that contagion is what is so terrifying. I look at an analogy from one of the congressional research reports in our sources. detailing the September 2019 drone attacks on Saudi oil facilities.
Oh, that's a great comparison.
In a single day, crude oil spiked 14% because the global energy market has zero slack. The Eurodollar financial system operates with that exact same hair-trigger sensitivity.
A massive carry trade unwind wouldn't take months. It would be lightning fast.
Which brings us to the regulators. How do they even handle something that fast?
Well, that velocity is precisely what threatens the regulatory infrastructure. If we analyze the relay model of global decision systems from the source materials, it maps out the concept of bridge nodes in a network.
Bridge nodes, right?
Yeah, a bridge node is an institution that sits on the critical pathway connecting different layers of a system. The SEC scores incredibly high on what network theorists call betweenness centrality.
Okay, let's unpack that concept of between this centrality, because this feels like the real danger zone. It's like a massive traffic grid.
Exactly. They act as the primary bridge connecting the private finance layer to state regulatory authority.
So the SEC regulates the domestic endpoints, the onshore broker-dealers and public markets, but the actual engine of this leverage, the Eurodollar liquidity, is happening in the offshore ocean where the SEC has no jurisdiction.
Which is a terrifying structural flaw.
Right. If billions of dollars suddenly evaporate offshore due to a yen spike, the SEC's levers pull on nothing. The bridge node becomes a bottleneck.
When a bridge node with high betweenness centrality is overwhelmed by a shock originating outside its jurisdiction, the standard regulatory circuit breakers just fail. The contagion bypasses domestic firewalls because the leverage was never domestic to begin with.
So if the SEC is mathematically guaranteed to be overwhelmed as a bridge node, and a multi-trillion-dollar carry trade bomb goes off, who actually catches the falling knife?
We have to look at the ultimate systemic backstop.
The Federal Reserve. The Library of Congress historical sources remind us that the Fed was founded in 1913 directly in response to the Panic of 1907. Its primary purpose is to act as the lender of last resort.
Yet, as we just established, the Fed does not govern the offshore Eurodollar market either. However, it exercises latent systemic influence through swap lines.
Swap lines. So during a severe liquidity crisis, the Fed will supply dollar liquidity to foreign central banks,
Effectively flooding the global system with emergency dollars to prevent a total freeze. They don't regulate the offshore margins day to day, but they act as the ultimate liquidity backstop when the offshore system seizes.
Here's where it gets really interesting, though. The nature of how the U.S. government intervenes in these crises has fundamentally shifted. There's a massive temporal mismatch here. Let's compare the speed of the problem to the speed of the solution.
The mismatch is glaring.
A carry trade unwind happens in minutes or hours. In 2008, during the Great Financial Crisis, the government intervention was entirely reactive. They scrambled over weekends to bail out GM, Chrysler, and AIG to stop the immediate bleeding.
But today, the Deloitte research highlights a completely different approach: civil-military fusion.
Exactly. The focus has shifted from reactive financial bailouts to proactive national security investments. Through legislation like the CHIPS Act, the government is pouring tens of billions into companies like Intel over years and decades.
Driven by great power competition and fears of IP theft, as Deloitte points out.
Right. The government is taking an active, long-term role in shaping the private sector. But you cannot use a 10-year semiconductor factory build-out to fix an overnight Eurodollar liquidity crisis. The government's new tools are completely misaligned with the speed of an offshore financial contagion.
It creates a fascinating dichotomy. The state is highly proactive regarding physical supply chains, but remains structurally reactive to offshore dollar leverage. And it is important to recognize that the very concept of these massive central bank interventions is highly contested.
Yeah, it's definitely worth noting for you listening that our source stack includes some heavily dissenting views on the motives behind these interventions. And we want to be totally clear, we aren't here to validate these claims or take a political side. We're just impartially reporting what the materials cover.
Right, our job is just to lay out the arguments.
Exactly. So looking at commentary from former government officials like Catherine Fitz, she argues that the events of 2020, including the economic lockdowns, provided a necessary cover for central banks to print $6 trillion.
In her view, it wasn't about public health, but about saving a failing financial system and preventing hyperinflation, pointing toward a deliberate global reset.
And similarly, the documentary Bailout characterizes the interventions of the 2008 financial crisis not as necessary rescues, but fundamentally as fraud. Including these perspectives highlights the deep systemic distrust that exists.
The scale of the intervention inevitably politicizes the monetary architecture. When a central bank uses swap lines to bail out foreign institutions participating in a yen carry trade, it becomes incredibly difficult to explain that to the domestic public.
Especially the public bearing the inflationary consequences.
Right.
So what does this all mean? If you are navigating this market, watching that yen stretch past 162, what should you actually be watching?
The sources give us a very clear mechanistic watch list. First, monitor the rhetoric from the Bank of Japan for any credible signaling of rate hikes.
Because that alters the fundamental math of the trade.
Exactly. Second, watch the USD-JPY price action around the 162 to 163 level. Historically, that is a danger zone where the Ministry of Finance has intervened.
And third, keep your eyes glued to those high-yield credit spreads. If they start widening rapidly from that 280 basis point floor, it means the forced liquidation has begun. The offshore money is fleeing U.S. credit.
And finally, the sources strongly suggest maintaining a resilient cash buffer in this environment. It's vital to survive the volatility of an unwind.
To sum it up, it's a classic macro setup. The yen-gary trade is highly supportive of risk assets today, but a ticking time bomb of fragility for tomorrow.
If we connect this to the bigger picture, there's one final layer to this network analysis that recontextualizes everything we've discussed.
Oh, the epistemic infrastructure part. This blew my mind.
It's wild. If we look back at the relay model, the researchers dedicate significant attention to what they call epistemic infrastructure platforms.
Yeah.
We are talking about massive academic and scientific databases like Semantic Scholar and OpenAlex,
The model identifies these platforms as monumental bridge nodes.
because they algorithmically control the visibility of research. They dictate what data, what theories, and what models get seen, cited, and adopted by institutions.
Wait, let me logically unpack the implication of that. If Semantic Scholar or OpenAlex algorithmically suppress heterodox systemic risk models, maybe filtering out specific warnings about eurodollar fragility, then the primary regulators relying on that research are literally flying blind.
That is the core vulnerability. If the epistemic infrastructure shaping our economic baseline has algorithmic blind spots, then the very risk models our financial institutions use to predict this impending credit crisis might be fundamentally flawed.
Flawed by what they are mathematically prohibited from seeing.
Exactly. If your structural map of the financial system deletes the exact offshore ocean where the leverage is built, how can you possibly model the contagion when it unwinds?
That reframes the entire threat. We are relying on highly sophisticated institutional models to protect the system from a 162 yen carry trade unwind. But those models are only as accurate as the epistemic infrastructure allows them to be.
The offshore leverage is peaking, the U.S. credit markets are happily ignoring the divergence, and the regulators might not even have the vocabulary to see the wave coming.
It's a lot to process. We highly encourage you to pull up the FRED data and those long-term USD JPY charts we discussed today to explore this setup on your own. Thank you for joining us on this deep dive.